the demand has been suffering, not had been. God forbid it's an uneven deal. I mean, we get more than China does. I mean, we are taxed more than tariff more than China is. Then obviously it's a problem.
We are off IT right now.
Totally off IT.
Thank you very much for joining us for another Market Pe Charcha episode. Really, I mean, we've been having the kind of environment for which has been very volatile for quite some months, and then from there we have seen some stability with a massive, I mean, I would call it a massive kind of a rate cut which has come recently. So then, straightforward, jumping to the first question, that budget was good, which was like to drive consumption, and then the rate regime started from there, and then again a double kind of a rate cut, right, which has come, which shows that urgency towards the growth. Where are we heading to from here? Where do you see all these, whatever is happening, taking the markets in the next year or a couple of years time?
Okay, so basically I'll put the market aside. Let's talk about the infusion of liquidity and the cut in interest rates, and then we'll blend it into the markets per se. So here's how it panned out, right? The demand has been suffering, not had been. It has been suffering for a while. And when I'm saying demand, I'm talking about retail demand for consumer products. No, I'm not talking about the markets. Markets are a different ballgame altogether. Yeah. So the retail demand for consumer products has been suffering. Now, I'm sure the government was cognizant of the fact when the RBI governor changed late last year, his first reaction was to infuse liquidity in the system, because that's what was constraining the demand in a way. So he started small baby steps, seeing what the impact on the rupee was. And fortunately for us, US started this tariff negotiations with all the countries and stuff like that. And as a result, their dollar started coming under pressure. Right. By then, our government was also fired another salvo in terms of boosting consumption by way of increasing the tax slab from 7 lakhs to 12.75 lakhs, right? With the exemption of 75,000, that's what I'm talking about. The way was 7 to 12 lakhs. So that was a big booster, not really a booster, but it was an indicator to the consumer. Look, we are there. We are there to support you. Please start consumption, right? But that's not the only thing that drives a consumer. The savings doesn't drive a consumer. He needs to see some kind of a safety net in front of him before he starts spending, right? So anyway, it was followed up by RBI with constant cuts in CRRs and all that. And I think because of what was happening in the US, the dollar was anyway under pressure against all global currencies. And I think RBI very smartly realized that, look, I can get away with this. I can get away with a huge cut in CRR and infusing huge amount of liquidity, 2 lakh odd crores odd, and also cut interest rates drastically, I mean, very sharply by 50 basis points. And I don't think my rupee will be impacted to that extent. And it so happened also, right? So that was the, I think, thinking behind RBI. Obviously, they wanted to give a big boost to liquidity and to cut in interest rates so that the consumer can wake up and say, okay, look, now is the best time to start purchasing, right? Now, one thing that would have triggered this obviously was the waning demand as such, which was going on. So I don't see that moving away as such. However, what happens normally is the safety net that I was talking about is mainly the consumer safety net, is mainly if he sees some kind of a growth in his existing salaries, or if he sees some new job creations happening. This is the safety net that the consumer looks at before he starts spending. Now, the NSE 500 numbers which came out, now I'm talking about results now. If you see the hike in salaries in that particular year was only 3% across 500 or top 500 companies of the country. Yeah. And that's mainly so because there were quite a few layoffs along the way, and that's why the salary was compressed. I don't think it was below inflation as such, but whoever remained may have got some hikes. But the ones which were let go obviously saw the salary bills getting compressed, and as a result, the overall growth was 3%. Right not a healthy sign for a consumer, for a consumer confidence, right? Even in the case of new job creations, we need almost 1 million jobs a month to compensate for the amount of flows that we're seeing in our employment pool. Not happening right now. The only jobs that are being created are either gig workers or at the infra end, which are blue collar jobs. They're not the white collar jobs that the graduates would look for, which are Ivy League guys would look for, right? So that's not happening. That can only happen once the private sector capex kicks in, right? Unfortunately, the private sector capex depends on retail consumption before they start implementing the capex, because they're seeing the capacity is lying idle. So obviously they will not be that keen on pushing capex today. So that is where I feel that probably it'll take a couple of quarters before this low interest rates, this huge amount of liquidity starts making some dent on consumption. And when that starts happening, you'll see the capex also kicking in, and you'll see employment moving up, and you'll see the consumer confidence moving up, and so on and so forth, right? So our feel is that probably the last quarter of this calendar year, which is the December quarter, when all the festive season, the whole festive season in our country is compressed, that is where you'll see some kind of a feel-good factor coming in. You'll see some spending happening, where savings is happening. There's no doubt about that. But you need, for big ticket spends, you need that comfort to come in also. So that's why I think that is the quarter that one should look at. Having said that, going back to the markets, which was the second part of your question, the quarterly numbers, I mean, ultimately the markets are driven by fundamentals. Market can work on flows, but ultimately the fundamentals have to kick in some way or the other. And that unfortunately has not been happening. And as I said, that main reason was the waning of demand at the retail end. Obviously, it impacts all the downstream industries also to that extent. So what happened was that probably the quarter of March, which we expected to be a tough quarter, didn't turn out to be so. In fact, the drop continued into the March quarter. The earnings growth have been in low single digits, in fact, mid-single digits, and that is not the exciting part. And looking at the commentary of the management who came out with the numbers during this quarter, the commentary also hinted towards a very weak April and has been trickling into May as such. Yeah, I don't think June will be any different, given that there were a lot of issues. I mean, the monsoons seem to have just stood the ground, not progressed much beyond that. So I think June also may not be that great. So basically, the June quarter again will be a kind of a washout quarter, a disappointing quarter. And September, the hope is that September will just turn out to be a tough quarter. Why? Because September of last year was not a great quarter anyways. So maybe that is what will come into this quarter itself. Will reflect in September quarter itself. And probably December is when the party will begin. As I said, that consumption should kick in there. Having said that, a bit on valuations also. If one sees, so basically the FII flows are driven by this animal called MSCI, Morgan Stanley Composite Index of India. And that index, normally when it touches, so if you see the past 3-4 years or so, whenever it's come close to 25 times forward earnings, there's been a correction. One saw that in, I think started in April of 22 till I think June of 22, there was a massive correction. And that was basically because it was close to 25. Again, in September of 24, when the correction kicked off, it was close to 24 times forward earnings. Even today, it is 23 odd times forward earnings as such. So we're very close to somewhere near the peak. We're not calling out a correction at all. We think there'll be a time correction, if at all. And that's mainly because going to be driven by, obviously, the kind of flows that we're seeing in the domestic part, as well as the mutual funds are sitting on probably 1 lakh crores of cash in the books today, 2 lakh crores of cash in the books today. So that's also a buffer that is available. FIIs are trickling in, but I don't see that impacting the markets much going forward. So maybe there's a time correction built in. And hopefully, as I said, that December will be the cup party quarter going forward. Mind you, Devi, in a time correction doesn't mean that the whole market is flat. It means that certain portions will move up, certain portions will move down. And that's why I would love to see only those managers who constantly churn their portfolios and change according to our times to keep in touch with the flows per se.
So Dinsha, you mentioned about FIIs. FI has been massively underweight India for now quite some time. What's our thought? I mean, when do we see them coming back? Because see, valuation obviously on a relative basis is a issue for them, but I think the point which they are missing is the contributions to that elevated PE, right? A stable macro and all these things, which is happening right in India. So when do they, I mean, will start thinking on these lines and rather than looking at PE as on a standalone basis, and also consider the kind of growth this market is offering, and they would, turn back to India and become massive buyers? What do you think about it?
So FIs actually are a very confused animal today. They have almost a 5% return in dollar terms, close to 5% in 30-year bond in the US. They are in fact shifting more money into China than they are doing into India. So they are fairly confused today. But I think the whole flow, the big flows. I mean, right now you are seeing a trickle, right? 1,000 crores here, 2,000 there, and stuff like that, which is not the way they sold. They sold 7,000-8,000 crores a day when they wanted to sell. So it's just a trickle today. And I think the call they've taken today is that, look, the rupee has done its bit. It's corrected quite a bit. The markets did correct. They come up again. But yeah, from here on, probably we have to be a bit more conservative going forward. So that's why that trickle, the flow which started, can turn into a trickle. And I won't be too surprised if they turn slightly more negative also on India, given that we are almost close to that 24 times forward earnings going forward. But I think the bigger issue is how will this trade negotiations pan out? I think that's what the trigger for the big flows into India will be. Whatever feedback we've got or whatever we've seen in the public domain today, it seems China is turning out to be a bit more stronger on the negotiation front than India is, which is not good news for India, because all along we have felt that US was not, I mean, they were very angry with China and they were looking at India as a sourcing base. It doesn't seem to be working out. I think US is maybe having a deal with China on maybe have a faster deal with China than they would have with India. Even if it's an equal deal for both, say China and India both are at 10%, that again is not good news for India, because India we always felt that we'll get a sweeter deal than China. So I think that is what is holding back the FIs. And whenever this comes out, and it's not too far away, it's probably a month away now, exactly a month away. 9th of July is when the new deals will be structured, or if you haven't structured the deal, you'll go back to that 26% odd rate that we got. I mean, duty rate that we got with them as such. So that way. So I think they'll probably be looking at India fresh after the July numbers when they come up. July deal comes out as such. So
what we are in general, getting to hear or read is that, that we are at very advanced stages of, closing a deal with US. Is that, I mean, is it like, just a assumption, or is it like, something of that sort happening? I mean, in reality.
So I'm as privy to this as you are to whatever appears in the newspapers. But the fact that when you look at Chinese media or we read up these international newspapers, it seems China's on a much more fast track than India is. They've been negotiating constantly with China as such. We are on and off the table as such. So I don't know what's happening really, but my feel is that even if it's an equal deal for both, God forbid it's an uneven deal. I mean, we get more than China does. I mean, we are taxed more than tariff more than China is. Then obviously it's a problem. Otherwise, even if we get an equal deal, I think it'll be an issue for us, because we always thought that we were going to get slightly more favorable stance from the US than China would. So
now the rate cut and the entire thing, which is sort of hinting towards that, that the maybe the central bank or the government wants, people to borrow, right, more. That's one of, and uh, if you look at the private, capex, that's at the, or maybe, that's indication is to the corporate debt, of corporate debt to GDP, which is at about 50% right now. So what do you think of that? I mean, do we see, because the last cycle also we have seen that, the corporates in general, they went against their trend, right? In general, we have seen some of the largest, metal companies and all, most of the times when the rates are down, they coming and heavily borrowing and all. But last time, we saw that, they paying it back rather than, borrowing. So do you see really that onset of, private capex happening in the next near future, or maybe in a 1 year, 2 year down the line? Because that would actually pave the way for a much larger, kind of a participation of financials in the overall thing. Because financials has been largely, they haven't done well, right? I mean, for a quite in the recent past, they have done well, but otherwise they haven't. So what's your thoughts on this?
So, okay, there are quite a few questions built on this. So let me start off with how private sector capex impacts the overall economy. Now, whenever the government spends, the government normally spends on these infra projects, right? Ports, roads, bridges, and such like that, right? These are, I would say, productive assets, but they're productive in a different manner. I mean, they are more of, connecting one part of the country to the other, one part of the world to the other, and stuff like that. So normally when you employ people out there, you employ them only for that project. There's no multiplier effect out there. Once a road is set up, you'll have traffic on the road, but it's not employing people, right? It's making your transportation logistics much more efficient, right? So that's the government capex. But when a private sector capex kicks in, it's mainly on a productive asset. Suppose the demand for cars goes up, right? Probably a foreign company or an Indian company decides to set up an auto plant because their existing plant is over capacity, right? So they want to have additional capacity. Obviously, they don't wait for the over capacity to happen. Once they see this flow happening, they see their utilization moving up, they start implementing another project, a brownfield project probably, which is expanding and all. Once they do that, you can imagine the kind of ancillary services that come about, right? There'll be one body plant which will come up for metal forming. There'll be a plant for tires coming up. There'll be a plant for engine casting coming up and stuff like that. So it'll be a multiple plants all around, a steel plant, ancillary plant, aluminum plant. All these plants will come up, and that is where the real employment infusion happens. So one plant with these ancillaries around multiplies the effect of employment, and these are long-term employment projects. They're not the ones which will get over in 4 years or 5 years, right? This is for lifetime. So that's where the beauty of private sector capex comes in. Now, unfortunately, that has been lagging. So I remember meeting one banker recently, and he said, like always, in the last 2 years, I've been telling people, private sector capex is a quarter away, right? This has been happening for the last 2.5 years. So the fact is that things are not that great for the private sector to kick in. Low interest rates can lure the private sector capex, but the fact is, for them to get into a productive assets, they need to see some offtake happening on the retail front before they can commit those kind of big monies into such projects. So that is where I think the difference lies out here as such. One more question within your question, which I think I missed out, but I don't remember now what exactly it was. But anyway,
it was more to do with the capex only. And then, do you see more rate cuts coming from here?
Basically, if you notice, I mean, the RBI was very clear that they're changing the stance from accommodative to now neutral. What they basically said, in not so many words, is that, look, I've done my bit. Probably this is the last cut you'll see in this year. Probably if things work out the way I expect them to work out, maybe you'll see one more cut in December by the end of this year, but not before that. I am in no position to do it just now, because obviously RBI also needs to keep a buffer. It needs to keep a buffer because tomorrow if the global economy turns bad, they need to have enough in their hands to start cutting to boost our economy per se. So I think that's what they're working on. They've from that front foot betting, they've gone on to back foot, and I think they're just trying to now do defense than rather being aggressive in their hitting us. So I don't see any further rate cuts coming forth in the near future. Probably by the end of the year, not before that. Liquidity again, they're down to 3.5% on CRR. I don't know how much they can more further cut. I don't think they'll do that either. I think there's enough liquidity, 4 lakh crores plus of additional liquidity in the system. So I don't see a problem there also.
So let's talk US. I mean, US, do you think is like now is being pushed towards an inevitable slowdown in US, Dinshaw?
So basically, I think they need that too, because I think the problem with the US today is that if they don't do that, they go into a stagflation kind of a scenario where the inflation is high and obviously there's zero growth rate, right? Now, the problem that Fed is facing today is that they can't even cut rates. Though the world is cutting rates, they can't do that because the policies that they're planning to implement are definitely inflationary. I mean, the OBBB, with one big beautiful bill that is now lying with the Senate, if that goes through, you're talking about another $2.5 trillion of deficit kicking into the system as such. That's almost 9% of the existing economy, right? And that 9% was probably what they ran during the World War II, which was when they were really pushing the economy per se. So I think that is what's holding them back. Already they're running a deficit of 7.5% on an annual basis, which is not a healthy sign at all, right? And if you're cutting your, if you're increasing your deficit 2.5 by cutting down on taxes, basically what you're trying to tell people is you spend, right? And I'm going to print money and give it to you. So basically it's inflationary and low growth as such. So I don't know where they're heading. Obviously, the bigger dent has been made in dollar being the reserve currency of choice. That is where the bigger problem lies. If that goes away from US, then they definitely have a problem, long-term problem on their hands as such. I mean, if you're a currency of reserve, by definition, you have to run a deficit in your books. I mean, suppose me and India and US are in a trade relationship, and India's exporting more to the US and bringing in less from the US. Obviously, they would like to own dollars because that's what they're earning, right? More dollars they're earning than sending out more dollars. So it's surplus lying with me. What is the need for me to have a US dollar surplus if you are going to run at parity, right? So that's where the question arises. And I think if they go about that, there'll be a question. I think if anything, the biggest gainer will be the euro area. EU, the euro currency will be, I think, the next choice of currency of reserve. That's the second largest currency anyway in the world put together. So I think that's the next best choice. Maybe that is what's going to happen in the future. But obviously, I mean, right now, US is in a flux. You've seen what's happening across the US. I mean, I haven't seen Marines out on the streets in Los Angeles in a very long time. I don't know how that turned out, but anyway, so it's a bit of a mess out there, and hope they come up, because if they don't, you're talking about the 25% of the global economy going to doldrums, which is not what the world wants. China already is in a slight mess. That's 20% of the global economy. So 45% of the global economy in a mess, the world can't progress further than that.
Yeah. So then, Chad, coming to India back, in beginning of the year, we saw, many managers talking about large caps as the safer, but last 2 months, if you see, again, small and mid caps have done well. While we did come out and we launched our mid cap in Feb, and and the investors, those who invested, made good. But do you see this sustaining from here? Where do you see all these three pockets or segments of the market moving? So which one where to put the money. Is flexi cap the best bet, or is large and mid the best bet, or one should invest in mid cap now from here?
So surprisingly, Devi, when you dissect the NSE 500 earnings, the large caps had low, say 1 or 2% kind of growth. Nifty 50 had around 2% growth in earnings, right? I'm talking about the 100 in the NSE 500. And if you take out the small caps, which is 250 of the stocks, they had a negative 8% growth in earnings. The one which really propped up the mid cap portion had an 18% growth in earnings. So that was the one which really moved. So I don't have any doubts in my mind that mid cap is the way to go today. In fact, if you, I don't know how many of you guys have noticed our weight in the large and mid cap fund also that we had. We were more skewed towards large cap. Now we are almost equal on large and mid cap both. I mean, there's one small cap stock out there because that didn't classify as a mid cap. Otherwise, it was 250 first stock, which he had picked up, which we thought will classify into large cap. So that's the only small cap there. So I think that is the way to go. And in fact, my comfort lies totally in the mid cap space today. I think the growth shares are pretty good. They're taking away market share not only from the small cap guys, but they're even challenging the large cap guys. And that's why that growth is much more exciting. These guys are more nimbler on their feet. They have a lesser, much more agile. They have lesser debt. They're cash heavy. So they can very well challenge the large cap guys who are debt heavy. Small cap guys are definitely more on debt, less agile and stuff like that. So I think this is the place to be in. And that's why we're being where we are today as such in the mid cap space. One more thing, Devi, I wanted to add to your previous question, which I forgot to add was, so if you look at the world, if you look at the global economy from, say, the post-world era, which is 1945 onwards, 45 to 70 was when the world was repairing itself. So you can't even grudge the emerging markets lagging, and the developed markets, which was actually the one which was at war with each other, was the one which was growing the fastest. 70 to 90 was a period when it was a total turmoil. There were these oil wars going on. There was this oil shock which came about. A lot of issues. Finally, it got sorted. Cold War was getting into a heated area and stuff like that. Finally, it got started with Russia imploding, USSR rather imploding. And that's when the Cold War gave away. The best period that the world saw was from 1990 to 20. That's when the whole world GDP was growing at the fastest clip ever on an annualized basis. And that was mainly because there were peace, there was no grudging each other, trade was open, outsourcing was rampant. And by the way, US, which was 15% of the world economy, with this open economy that they were running, with the existing administration says that we lost out on the global front because we were so open to the world trade. That economy from controlling 15% of global GDP has gone up to 25% of global GDP, despite them being open to outsourcing and stuff like that. So I think that was the best period. And now we're going back to those 70s period when you want to put tariffs in place, you want to compress the world. So it's a bit of a turmoil. I think one has to very interestingly look forward to this. So that way, there's an old Chinese proverb which says that which says, may you live in interesting times. And I think we are today in a very interesting time. So I have to be very cautious.
So on a 2 to 3 year, sort of a medium term, which are these sectors? Let's not talk maybe 1 year. Let's talk 2-3 years. Which are these sectors which you see would actually surprise investors or maybe the managers, right? I mean,
yeah. So basically, okay, one thing, a caveat to that is that there will be a deal for everybody, right? That's the whole caveat. Maybe some will get better, some will get worse, but probably India will get an even deal with the world will, right? That's a whole basis of our thesis right now. If that happens, we are looking at mainly the domestic-driven economy, sectors in the economy, which will drive the economy per se. And frankly, I mean, my belief is even if India gets a even deal, we don't have a problem. Our economy will be the third largest very shortly. I mean, probably by 28 or calendar 28 or 29, we'll be the third largest economy, leave behind Germany and Japan. Japan and Germany is in that order as such. So that's why we'll be fairly well placed to see global flows. We're fairly well placed to see growth, right? So here is how it will pan out. I mean, that's what our feel is, that if you look at what the world did, rather what India is going to do in the next 10 years is what probably US did in the 70s, or for that matter, Japan in the 80s, or Germany in the 90s, and China in the 2000s as such. Yeah, and that's what we're going to repeat for the world per se. In those scenarios, when you look at those countries, the one sector which stood out quite appreciably was BFSI. BFSI was phenomenal, saw a phenomenal run, not only because it was partaking in the consumption boom, which was driving that economy, but also partaking in the infra boom, which was needed to push that consumption going forward, right? And that's where the thing came from. So that's why we believe that BFSI is a total standout. Once your per capita GDP start moving up, obviously domestic tourism takes a big chunk of that pie. So here's how it works. So you have a wallet, right? One, if the wallet is small, you'll spend a good chunk of that wallet on your basic needs, food, water, education, and stuff like that, right? Once that wallet becomes bigger, you may appreciate on your food, you may buy some luxury articles and stuff like that, as in you'll buy better food and stuff like that, but you're still left with a big chunk. So that first chunk will go towards your healthcare, right? So you will start insuring yourself. Under penetration insurance is a given, right? Once you do that, you will start trying to look for quality healthcare offerings because you're already insured. You don't have to spend much. So that's where we come from on the hospital side. I think hospital industry, given the limited amount of beds that they have, there'll be massive run up in their RPOPs, average revenue per occupied bed. And that is where the real boost in earnings will come from. Obviously, they're adding more quality beds and stuff like that. So that's one chunk. Secondly, will be on leisure. You will want to travel more. You'll want to go and see various places, fly the airlines. So that's where we come from on the hospitality and the aviation side. I think that sector also going to do phenomenally well. Also, the new age companies. This is the way India has to go, right? And this is something which is very unique to India, the platform companies that we've developed, and there are quite a few of them. I think those are the ones which are a standout. There'll be a domestic capex play happening. So we are also selectively in domestic infra plays, per se, capex rather, related infra plays as such. And then obviously you'll need more and more of power. Again, the only problem with power is that transmission is controlled by the state. So there are a lot of NPAs out there. Production is controlled by certain central companies. They are okay, but not that exciting. I think the equipment suppliers to this space are the ones which you want to play with, and that's why they're where we are. So that way. Oh yeah, one more thing, Divi. I remember when you asked me about that question on the capex bit, private sector capex, it was related with debt. You said the private sector debt was at 50%. I just recollected that is what you said. So this is the way to go actually. If you look at an emerging economy, I think 50% is too low a portion. In fact, at some point we were at 80-odd%. Private sector, yeah, and that I think is the way to go. In fact, any visitor who comes to India, and we get quite a few out here because we run a FPI also, they're very taken aback because they land at 2 o'clock in the night, and the amount of traffic they want to see on the streets. They say, "Wow! I mean, we've never seen that traffic during peak hours also in our countries, respective countries." And I tell them that only. This is what you see in an emerging economy, which is fastest growing. So that's what's going to play out for us also.
So what you're saying is that okay, rate easing leads to maybe 2-3 years down the line, what we're talking about consumption. Obviously,
actually consumption
private capex. Private capex would lead to industrials some bit, right? Industrials growth in industrials also.
Yes, very true. So that's where we're coming from. Obviously, there'll be a lot of ancillaries around also. So.
And the retail and travel and tourism, right? So basically the larger thing.
This is what's taking up the larger part of our chunk.
Okay. So what's our outlook on the most favorite theme in these in the recent couple of months, which is defense.
So defense, yeah, I think basically one thing that incursion that Pakistan, I mean the not rather the response that India gave to Pakistan was obviously one which was eye opener for the world, because we, I think, fought off Chinese technology. We probably had a bad hour or so, but we learned from the hour and we changed our tactic immediately and responded back with a bam towards that as such. So that basically proved the prowess and the versatility of Indian defense manufacturing, right? I think that has made the world stand up and say that, look, India can be a sourcing base for defense products, right? Fortunately, we are a very peace-loving country. We've never done incursions into, unless we've been provoked, we haven't responded to otherwise, right? We've never done unprovoked responses and stuff like that. Only when you've been provoked. World loves that. World loves a friendly country who's been a peace-loving country all along. Obviously, having a big defense setup as such. I think that is what the world will look at, and that's why I have no doubt in my mind that we'll be a sourcing base for defense. But unfortunately, our capacities are fairly limited. We're not capable of, like, for instance, if you're a ship manufacturer, you are limited by the amount of docks that you have at your discretion, right? Now, the problem with docks is you can't, if you're used to manufacturing 4 ships a year, if you even get orders for 10 ships, you won't be able to finish off 10 ships because you have that limited capacity to have those docks in place, right? So you need a lot of capex there, and that's what I think is going to pan out at a later stage. Unfortunately, most of these capex heavy companies have the valuations have gone through the roof. I cannot justify those valuations at this level as such. So if you look at our portfolio, we probably have only one defense name, though we are very bullish on defense. We have only one name, and that is also because it's in electronics. And fortunately, unlike other defense players who are specific to the arm, that particular arm of the forces, electronics is used across the forces, be it airlines, be it army, the field forces, or be it even Navy, right? And electronics is very versatile. It can be, the capexes required are not that heavy. So obviously, that is the one which is making us very bullish on that particular play as such. So that way. By the way, one downside which happened because of this argument, I mean, this war that we had with Pakistan, was that that the capex spend which the government was doing on their public sector, I mean, rather the public capex that they were doing, has been slightly diverted to defense now. So that capex also has taken a slight backseat, not too much, but a slight backseat. So that's the only downside that has happened.
So would that mean that there would be some impact on growth also then, Sean?
I won't say the growth will be impacted, because I think that's where they've taken a very conscious call. And fortunately for them, they have enough surpluses lying with the RBI to play that out. But as I said, that maybe it'll be delayed a bit as such going forward. And growth is a function of how much you spend, right? It doesn't matter whether you spend on defense or you spend on infra. So that is not going to be impacted to that extent.
So, so there has been a lot which is happening around in solar energy and power and all that also. What's our take on power in specific, from a medium term perspective? Where do we see that moving because of whatever changes in demography or lifestyle which is happening in India?
So basically, power in the long term will be a big beneficiary, no doubt about that. But it's the short-term blips which you have to manage. Obviously, renewable energy will be the one which will be showing the way as such. We are also cognizant of that fact. But unfortunately, there are very limited plays in renewable energy which are coming by. And you have to be very selective out there, because even the listed players who are there in the power manufacturers, rather, they are fairly stretched as such. So we have to be very careful. That's why I said that the bigger party, I think, will happen in the equipment suppliers who are versatile as such. certain equipment suppliers, and you can look at a portfolio and you can conclude, are fairly, I would say, monopolistic in the technology that they provide. And that's why we like them so much. One thing that I think most of you would have missed is that when in the summers, in the peak summers, the power rate during lean time became negative. Means the transmission companies were ready to offer you money to take that power from them because they didn't have the capacity to store. That basically showed that there was certain surpluses that had been built into the system, but because of the weak, I would say, summers, that surpluses came by. So I don't, in the immediate short term, I'm not too excited, but obviously long term, I'm fairly keen on power as such.
I think, yeah, and in terms of from here the allocations, there is always a question in investors and then our distribution partners' mind that now where we are right now, does it make sense to go all in, or is it like they need to stagger even now, with all these green shoots which is visible in terms of rate easing and all that? Should they be going all in from a medium term view on the risk category, which is the mid and small cap categories, or they should be investing in flexi cap and let the manager take call, or they should do SIPs or STP? What is that which would be the ideal way of allocating?
So Devi, as I said, that my feel is it is going to be a time correction kind of market. It's going to be fairly listless. So I don't see any, even if you stagger it, if you do a STP or something, I don't think it's going to make a difference. However, one should be very clear that one should only invest in a manager who's been constantly churning his portfolio. Please do not be averse to any manager churning his portfolio because he's doing it for the good of the portfolio as such. I mean, I encourage all of you to look at my portfolio from probably Jan onwards. You'll see a lot of churn has happened in my portfolio. That's because obviously in a flat market, you see quite a few sectors which give you healthy returns, right? And that's what we're trying to capture. You'll see certain sectors which give you bad returns too. And that's what we're trying to avoid out here. And that's why I believe that one should be fairly comfortable with the manager who's been constantly churning his portfolio. You can always be in a flexi cap, but unfortunately, flexi cap, most of the ones which I've seen are heavy on the large caps. They do not take much exposure to a mid cap and small cap. So please look at even if you're looking at a flexi cap, which ideally should be the way forward, look at a one which has been constantly changing its portfolio. Same goes for a mid cap fund or a larger mid cap fund, where you're seeing that the mid cap is becoming heavier, because my feel is that the best returns going forward will come from mid caps. Obviously, there's a limited amount of mid caps available in the market, 150 of them. But still, I mean, if you remove the top 30, which are fairly frothy, I think 120 give you excellent returns. So, but that's my personal preference, Devi.
So in to summarize, while I have covered most of the questions which were there here on the chat box also, to summarize, what we're saying is that the portfolio is positioned towards largely financials, some bit of power and some bit of consumption ideas, right? Largely that's the positioning.
Hospitality, hospitals.
Yeah, hospitality and hospitals, essentially, right? We are off IT right now.
Totally off IT. Right?
And we are evaluating that as and when it's appropriate. Maybe
when some clarity comes through about how AI is going to impact IT. Obviously, right now there's a secondary overhang of US not doing too well, and that will impact IT per se. But AI will be a major disruptor for IT.
And we did talk about that, why we are bullish on financials, and I think that questions keep coming to us, but we keep explaining that why are we bullish on financials. We did talk about it, that what we feel is the onset of private capex at some point of time, and obviously whatever we are talking consumption and industrial and all that, I think all that need financing, and that's where we believe that financials should do well further from here. So I think with that, we come to an end of another fantastic session on Market Pe Charcha, and we look forward to the next one in the month of July. And till then, I wish everyone stay safe. COVID is rising, so stay safe and take care. And thank you very much, Dinsha, and thank you, partners, for joining us. We'll connect with you soon back again.
Thank you, everybody. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.